I care about where I'll be 10 years from now. And that's kind of what I'm focused on as a real estate investor. So the goal of this entire webinar, if I had to boil it down to one thing, I would say when you look at a real estate deal, it's really hard to figure out how much risk you're taking to achieve a certain amount of cash flow, a certain reward from a cash on cash or appreciation perspective. My goal is to dive into a very simple spreadsheet that I made, and I'm going to talk you through some of the risks. First, I'll talk about how they can amplify your returns. Leverage is, when used correctly, one of the most powerful tools there is in this world, in the real estate world. I'm going to talk about how it works with taxes. I'm going to talk about how it works with revenue growth and cash flow, and how it can amplify the value of the assets that you're buying. Then we're going to spend the second half talking about the risks, talking about all the things that are outside of your control as a real estate investor, and some of the things that are inside of your control and that you could just frankly mess up that do have, the possibility to take you under. And I'm going to talk about how people do go broke, how the things that keep me up at night, because as you know, my real estate portfolio is growing quickly. I'll give a brief intro on that. 1 year ago, we owned about $12 million worth of real estate. Now, today, we've acquired $75 million worth of real estate. It's worth, if we were to list it on the market, somewhere between $130 and $150 million. We have 40 people on our team. We've bought 45 self-storage facilities. And we have a growing machine that raises capital from a real estate private equity standpoint from limited partners. And we have another company that operates and has a name on these buildings. We deal with the customers, everything along those lines. So that's where I'm coming from. The goal of this webinar is to talk to you about how I think about debt, how I think about risk, and how it all works together. So let's jump right into the Excel spreadsheet here. So let's first talk about how net operating income is calculated. Revenue minus expenses, that's the net operating income. This has nothing to do with debt. This has nothing to do with deal level fees. This has nothing to do with certain extracurricular structures you may have set up. This literally means if this deal was unlevered and had no debt and no outside expenses, what would be the expenses and revenue and profit from this facility? Then after this, or from this piece of real estate. Then after this, you have an interest and principal payments to bank for the leverage that you're going to get. Let's use an example of a $1 million piece of property. We have $120,000 of potential. These are just made up numbers. Looking at a $1 million deal, it may have $120,000 of revenue, $60,000 of expenses. That's a 35%, or that's actually a 50% expense ratio. This is not correct. And we have the net operating income. Then we get to choose how much leverage we put on this property. A $1 million deal at 70% loan to value, which means $750,000 of leverage, means that we put in $250,000 of cash and $750,000 loan amount. This is a 6 cap rate. There's a lot of nuance around cap rate. There's in-place cap rate, which means the 12 months leading up to the current time. There is forward-looking cap rate, and then there's pro forma cap rate, sometimes 2, 3, 4 years in the future. In an interest-only scenario, which when debt market is hot and you have a lot of opportunity to get a lot of bankers that are excited about real estate, right now is a really good time to borrow money for real estate because bankers are really comfortable with it. It's been a while since the real estate crisis. You can get interest-only payments. And then you have different cash-on-cash yields and debt constants for these different scenarios. Debt yield and debt constant are two factors that most people don't really know what they mean or how to get them, how to figure them, but they are two very, very important things when I'm looking at a real estate deal. The debt yield is just a percentage as an interest rate that the debt yields in net operating income. So if you have $750,000 of debt and you yield $60,000 in net operating income, your debt yield is 8%. Some people, and if we were to put less leverage, and as I change these figures, you'll see the loan amount and the cash invested change. So here we have a 50% loan to value and a $500,000 loan. Now our debt yield is higher because for every $500,000 of loan, we are generating $60,000 of net operating income. This is basically telling us how much net operating income our debt is yielding. The debt constant, this is how much our debt is costing us. This is on an annualized basis, what's the total cost of our debt with both principal and interest? That's really important. So in a principal and interest scenario, you're paying both principal and interest. And I have the interest rate here. If we have a 5% interest rate environment, obviously see the debt gets more expensive. If we're amortizing a loan over 25 years, it is more expensive than 30 years. You'll see the cost go down. The debt constant is going down. That means in a principal and interest payment environment for a 5% interest rate loan over 30 years, I am paying a 6.44% debt constant. That means every dollar that I borrow is costing me 6.44% a year. And a hint here, the cap rate, if you're buying a property that yields 6% overall on purchase price, we paid $1 million for $60,000 of net operating income. This cap rate is actually, we're buying at a lower yielding figure than our debt constant. Our borrowed money is more expensive than the property is generating. So every dollar we borrow will actually cost us a little bit of money in annualized cash flow. Our cash on cash is below our debt constant. Now let's just increase or decrease our expenses here to run an example to $45,000. Now we're buying at a 7.5 cap instead of a 6 cap, because for every $1 million we spend on a property, we're generating $75,000 in net operating income. How much free cash flow? Well, that depends on how much you're spending on debt. And our debt constant is still 6.44% because it's a 5% interest rate over 30 years. So our cash on cash for every dollar that we borrow will actually increase. The leverage will increase the amount of cash yield that we are generating. But if our interest rate goes up 7%, now our debt constant is higher than our cap rate. So what's that mean? Our cash on cash for every dollar we borrow will drop. So let's run a couple different scenarios here and just show you a little bit about how this works. But this is the cash on cash. This is the debt yield. In an interest-only environment, obviously your debt constant is going to be the same as your interest. So if you tie in a 10-year loan, maybe it's a CMBS loan for 10 years at fixed rate debt, your debt constant may be only 5%. And obviously your cash flow is better on a 7.5 cap rate, and the deal will look a lot better. Any questions?
Yeah. Hey, Nick, a couple of things that are coming up from people. The first one I'll start with is asking, is the net operating income something that you would look at from an annual expense, or how would you classify that as annual?
Yeah, this is all annualized. Sorry. This revenue and expenses, these are all annual figures. So an example, a self-storage facility that's doing $120,000 of annual revenue might cost $1 million if you were to buy it at a 7.5 cap. So yeah, these are all annualized figures. So as we look at annual principal, annual interest, and annual free cash flow, as you tweak these and you'll have this formula, you'll be able to say, okay, if we actually are generating a little bit more in cash, $130,000 a year in revenue, our cash on cash yield starts to get amplified. But in a market like we're in today, a low cap rate, everybody talks about how real estate is frothy. It's really hard to buy deals. That's true. A small $1 million property, you actually may pay a 5.5 cap for, which means you're paying $1 million for every $55,000 of net operating income. It's going to be really, really hard to make the cash on cash numbers work unless you use a lot of equity or you get really cheap debt. You may get a 3.6% interest rate, but commercial real estate, you're generally looking at a 20 to 25-year amortization schedule. Now, the amortization schedule is a sneaky thing that really can cost people a lot of money on debt. 15-year am, your debt constant goes way up. Your debt gets more expensive. So if you're buying a 5.5 cap at an 8.64% debt constant, you're going to have not very much cash flow at all, 2.36% annualized cash on cash. So the couple people are asking about the relation between debt yield, debt constant, and cap rate. Mm-hmm. Debt yield is really, this is what I look at it as, okay, if my debt yield and my debt constant are equal, if these two things are equal, my property is break even. I'm breaking even. So let's say my interest rate's 6%. Okay, we're getting close. My debt constant's 10. My debt yield is 11. We're only generating $4,000 of cash. Let's say my interest rate goes up to 6.5%. Okay, now my debt constant is really close to my debt yield. It's getting even lower, say 7%. Okay, even lower, and 8%. So this is really a way to look at a piece of real estate and say, okay, to what level do interest rates have to go up? How high do interest rates have to go up before I am losing money? And look, this is a 50% levered deal. Most people lever up to 75%, 80% on loans. Okay, see, now our debt yield is much lower. The more debt you get, the lower your debt yield is. The less debt you get is, let's say we lever up to 25%, only 25% loan. We're putting in $750,000 of cash. Our debt yield is 22%. So as we start to think about risk, one way to increase your debt yield is to use less leverage. Not very many people want to do that because less leverage means more cash. Cash is king. These things are really tough. But 3.5% interest rate over a 30-year AM, our debt constant is going to be really low, 5.39. It's below the number of our cap rate. And boom, our cash on cash is higher than our debt constant. But let's put ourselves in a situation where we have to analyze risk. Me, Matt, I'm buying a bunch of storage. I'm trying to figure out how risky it is. In what scenario, if I'm about to buy a property, in what scenario would I start to lose money on a month-to-month basis? Now, judging by what I just told you in the last 10 minutes, the debt constant and the debt yield are the same. My debt is yielding the same amount that my debt is costing. So let's run some figures. Let's say I'm just going to use an example of a property that I bought recently. It was a $6 million property. I bought a $6 million property that was doing $42,000 a month in revenue. Let's do some public math here, get ourselves in some trouble. $42,000 annualized, that is $504,000 of annual revenue. I know that the expenses were about $175,000 on this deal. That's what I know. So it was generating $329,000 of net operating income. We're buying this thing at an in-place 5.48 cap. That means for every dollar invested, I'm generating 5.48 cents of annual net operating income. I borrowed about 60% of, well, actually, this is total cost, right? It's not just purchase price. The purchase price may be 5.8 million. And then we got some closing costs and other things involved. So my loan, the loan to value that I feel comfortable with lately is closer to 55%. And guys, this is much, much lower leverage than a lot of real estate investors go for. So we're doing this to reduce risk because obviously the debt yield, I want it close to 9-10% so that I know that if interest rates go up to 6% and I'm on a 25-year amortization schedule, if interest rates go up to 6%, I know that my debt constant and my debt yield still have 200 basis points between them. If I'm amortizing, if my loan's amortizing, let's say they go to 7%. Am I losing money yet, Matt? Nope. I'm still generating $50,000 of free cash flow. Not good cash on cash yield, but I'm not going to lose my property. 8% interest rate. 8% interest rate. We haven't seen this since 1985 or so. Boom. My cash on cash is still positive because my debt constant, I know that an 8% interest rate on 25-year AM, that's going to annualize cost me about 9.26%. We're going to keep going up. Let's go to 9%. Boom. Here we are. We're negative. So I know that if I'm buying a 5.48 cap rate and I got a 25-year amortization schedule, I know that at about a 9% interest rate, I'm going to go negative if I use 55% leverage. Let's look at what happened if I would have done 75% leverage on this, a lot less cash. Oh boy, not good. I can take let's see, can I take an 8% interest rate? Nope, still negative. Can I take a 7% interest rate? Nope. Can I take a 6% interest rate? Nope. So a lot riskier, right? Because if a 5.5% interest rate comes through, I'm negative. I'm losing money. So that's how I think about interest rates, debt yields, and debt constants. I like to see at least a 300 basis point spread between my debt constant and my debt yield. That means 3%, maybe even more, maybe even 4%. We're borrowing a lot cheaper than this right now. Okay.
Hey, Nick,
yep. Go ahead.
that was fascinating. And so I want everybody to know that as I'm watching this with a real beginner's mind. So forgive me if even some of the questions I asked might be a little below you, but it was really interesting to see how different pieces could be adjusted. And one of the things that people are asking in the chat that I just like for you to clarify is I don't think you're saying that your interest rates are going to vary or your debt rate is variable in this case. The way that I'm seeing this is thinking that what you're looking to evaluate when you're looking at a deal is, okay, if I can get a 5.5% interest rate in this scenario, that's what I want to go for. It's not that it's changing over time. It's just as you're evaluating deals and these different variables that you can evaluate, this is what I want to be looking for. Am I on the right path with that?
Well, this is what makes commercial real estate so hard. And this is what makes being a capital allocator so hard, because we don't have 30-year fixed rate mortgages like when you go buy a house. If you're getting a single family rental, maybe a short-term rental, you can get 30-year debt. And that really helps when you're locking in an interest rate. That reduces a lot of risk. You look at, again, the levers that are outside of our control. This one right here. These right here are the factors that are outside of my control. Interest rates in the future are very much outside of my control. The value of the property when I need to refinance or sell the property, that's outside of my control. So if you can lock this interest rate in for a really long time, that's a lever that you can pull as an operator to reduce risk. We're not so lucky in commercial real estate. We are on generally what's called bridge debt. If you have a value add strategy, if you are doing some things to improve a property, which I'm going to talk about here in a second, down here with this scenario, these operational levers that I can pull as a real estate investor to help me make more money. Those are the things that, I can't control interest rates. And when we are acquiring self-storage, we're using 3-year term financing. So that means at the end of 3 years, I not only don't know what my interest rate is going to be, but I need to find new debt. I got to go get different loans. So that makes my job a lot harder. But also we could get to avoid defeasance, which means prepayment penalties. There's a lot of nuance around this. But yes, this interest rate can actually float. A lot of commercial real estate floats over what's called Wall Street Journal Prime. So right now we're floating and our interest rate's 3.6%. But the Fed has said, hey, this is going to go up probably 100 basis points. We're going to do 4 raises, maybe even more. This might go up to 5%. So we're underwriting. Okay, what happens when it comes time to refinance? If I need to get new debt at 5% interest rates, what will this property look like? So these are all the things that I'm trying to control for as a real estate investor. Does that make sense?
Yes, it does. Yeah. I mean, I didn't even know about the difference between like that, how interest rate would adjust between commercial and residential. So, and that was very helpful by itself.
So let's walk through, we're going to talk a little bit more about controlling some of these things, but let's walk through a deal that I did recently with about a 50% loan to value means what you pay. This is loan to cost. This was a property that was a 55% loan to cost. It was a $6 million deal. We have about $3.3 million of debt on the property right now. It was doing $42,000 a month of revenue. And this was basically the past year's performance right here. Net operating income was about $329,000. We bought an in-place 5.48 cap rate. Now, why would I buy this kind of cap rate when, my cash on cash is not very good if I'm amortizing a loan? Well, the key to what I do as an operator, there's two sides of as a capital allocator, as a real estate investor, you can do one of two things. You can buy a piece of real estate with a long-term lease on it, and you can just hold it. You're not doing anything to it. You are holding it. You are cashing checks, and you are maximizing, just mailbox money. What we do at my firm is we make these properties better after we buy them. I'm looking now in the areas of things that I can control. The things that are in my control are how well we rent units, where the market rent, how high of a rate we can charge when we rent new units, how good of marketing we do, how clean our facilities are, how easy it is to rent, answering the phone 24 hours a day, things like that. Well, I know that the revenue growth at a storage facility that I've bought 45 self-storage facilities over the past 3 years. Over 35 of them were in the last 12 months. On average, we're able to increase revenue 35% at month 6 versus month 1. So the revenue is able to grow. Now, let's talk about how the leverage really helps amplify some of the benefits of being a real estate investor. The first one is operationally. You'd think a 35% revenue growth, Matt, just off the top of your head, if we can grow revenue by 35%, what do you think that might do to the value of the property? 35%, right? You might think, right, I'm going to increase revenue for 35%. But look, revenue is much higher figure than your expense ratio. So all that increased money, for the most part, goes to the bottom line, right to the bottom line. So in this case, a 35% revenue growth increases your profitability by 53%. Let's say let's just talk more realistic. Let's say a revenue growth of 5% and an expense growth of 5%. Both revenue and expenses both grow at 5%, but revenue is a higher figure than expenses. So your net operating income every year is going up 5%. So every year, the value of the property is going up 5%, but the equity, the value on top of what the loan amount is. The loan amount is 3.3 million. The cash we put in was 2.7 million. The loan stays the same. We're not going to owe more money if this property gets more valuable. We're still going to owe that money. So the equity growth, the appreciation that I've seen just through 5% revenue growth, 5% expense growth is 11%. This is an example of how leverage really amplifies things. Let's say we levered this property up 75%, which we didn't. We put 55% debt on it. But let's say I was very, very confident I wanted to take more risk. Not a very big spread here between the debt yield and the debt constant. Riskier deal. I need better risk-adjusted returns. But look, a 5% net operating income growth increases the value of the property by 20%. So that's how, this is an example of how leverage can really amplify your yield. Now, what we do at our storage company, we are very, very good at driving revenue. Like I said, on average, 35% more revenue at the 6-month mark than we had at the very beginning. So let's look at an example here. We bought this property for $6 million at a 5.48 cap rate. That's pretty close to market. That is a tough, these deals were available at a 6.5 cap a year and a half ago. Prices are going up. People are paying more money for the same amount of yield. So the cap rates are dropping. They're viewing these assets as less risky, whatever it might be. They're getting cheaper debt, all these things. But I know that 3 months in, I was doing $62,000 a month in revenue and not 42. So I went from $42,000 a month to actually $65,000 is what we accomplished last month in revenue. This is where you can make serious money very fast in the form of amplified returns of leverage. So if we increase our revenue by 35%, our new revenue annualized is $680,000. We took it from 504 to 680. Our new expenses are actually very similar to what they were, 175. Maybe they go up to 183. Maybe with inflation, let's say 7% expense growth. But our new net operating income goes from $329,000 up to $493,000. And look, if we value this thing at the same cap rate that we bought at, 5.48%, the value of this deal that we bought for $6 million is now $9 million. And our new equity, our equity that was 1.5 million. Well, actually, remember, we did 55% loan to cost. So our equity was $2.7 million that we put in. Our $2.7 million is now worth $5.6 million in six months later. And this is why the people who you see make serious money, big money in real estate, almost always have an operational advantage. They can do something to make the property more valuable. You say, okay, yeah, there's appreciation, there's market factors. Maybe this cap rate here, we get lucky and we buy it at 5.5. And next year, the market rate for these assets is 4.5. Okay, wow, our property is so much more valuable. But we didn't do anything. That's not forced appreciation. So what you see here, when you can actually drive revenue, maybe I give several examples of this in my real estate masterclass. I talk about my friend who buys large shopping centers, and they put an LA Fitness in those shopping centers on day one to increase the revenue in a major way and make those things way more valuable. Boom. Almost all of the people that you see making tremendous money in real estate have an operational advantage. So when people talk about real estate as a passive investment, that couldn't be further from the truth. It's really the special things happen with real estate when you can do things as a small business owner and when you treat real estate like a small business. How are we feeling, guys? Give me some comments here. You liking this? Post some questions over here. We're looking good. A lot of stuff going on.
Yeah, we've got a lot of action in here. One of the things that kind of popped out was, especially as you were looking at the loan to value, what are the benefits or the disadvantages, or is it just a more extreme version of, say, an interest only loan, or bringing that LTV even higher than, say, 75%?
Yeah, this is, people talk about, anybody can buy real estate if they're willing to take all the risk in the world. And when you are considering investing in something, or you're considering investing with a sponsor or buying your own piece of property, this LTV, this is really how levered the property is really the number one factor of how much risk you're taking. Yes, you can really amplify your returns. Think if we levered this $6 million self-storage facility up by 90%, I only need $600,000 out of my own money to put in this thing. And I just 5x'd my money. I 5x'd my money in 6 months by increasing revenue by 35%. That's crazy, right? We're not going to get greedy here. where the downside is too big. The downside's too big if we go 90% leverage. Look at this spread between my debt yield and my debt constant. My cash on cash year one is zero virtually if I'm not able to do what I think I can do. And you're never really sure. When you buy a piece of real estate, you're never really sure how much you're going to be able to drive revenue. There's a lot of risk and assumptions that you have to make along those lines. So we are in a situation where we have a lot of access to capital, and we're thinking, okay, how can we maybe not hit them out of the park? Okay, yeah, we're underwriting if we can get an interest-only loan, 7.7% year one cash on cash. It's not that great, especially at an interest-only loan. But when you do your magic down here and you work on these things, boom, you can double your money. And we're talking millions of dollars here. And this is really the secret sauce and what all real estate investors are really trying to do. We'd be amiss if we didn't talk about the cash out refinance. So what do you do, Nick? The big question is, what do you do, Nick, now that you have a $6 million property and a year later it's worth $9 million? What do you do? Do you sell it? Selling real estate creates quite a big problem, right? You pay lawyers, brokers, transfer taxes, and income taxes in a major way. This $5 million of new equity value, doubling our money, it's $2.5 million. That may become $1.5 million after we pay all of our fees to sell. Instead, what you can do is go back to the bank. And the beautiful thing about commercial real estate is the bankers, they don't really care what you paid for it. They're not going to look at comps down the street, like if you're buying a house, what did this other house trade for? Commercial real estate is valued like a small business. How much money does this thing make? It's all valued based on how much money it makes. And remember, as an operator, I can impact how much money a property makes. So I go back to the bank a year later and say, hey, banker, I know we bought this deal for $6 million. It's now worth $9 million. We had a really good run. What do you think about putting some new debt on this thing? More loan, and let's fix a rate. We've done our big value add. Let's fix a rate, maybe get 5-year term on fixed rate debt, maybe 7-year term or 5 + 5, get longer year term. And my new value is $9 million. So what I'm going to do is I'm going to get a loan. I'm just going to mess around over here on the right side of this. I'm going to get a loan for 75% of that. And you might say, Nick, why are you comfortable going to 75% LAV or LTV right now? Well, remember, I've already bought it. That's number one. Number two is I have already done my work, taken a lot of risk off the table. I've been running the business for a year. I have a better feel for it. And number three is I can fix my loan. I can fix my debt. And I know that's going to have a longer term, because the number one risk in real estate is that, again, the term runs out on your loan and the thing is a lot less valuable. We'll talk about some of these risks in a second. But so I'm going to go back and get $6.7 million of new money on this property. Remember, we only spent $6 million on the whole thing, Matt. So if I come back and say, all right, I want $6.7 million of loan, it's called a cash out refinance. Boom. When that $6.7 million hits the bank, you pay off your $3.3 million previous loan. You pay back your $2.7 million of cash invested. You've actually got $700,000 of new money, cash out money in this deal. This is the holy grail of real estate. And this is how the really good operators basically get all their cash out of this deal. The beautiful thing about it is it's tax-free. You didn't sell it. You still get to own it. It's still going to cash flow from there. It's a wonderful, wonderful thing. And yes, banks are willing to do a cash out refinance. And yes, banks are willing to loan more, frankly, more money than what you created. People keep asking, how am I able to drive revenue by 35%? This is an incredibly important part of real estate, in that the average real estate investor is rich and honestly somewhat risk averse, and also sometimes not the best operators. A lot of real estate investors, I mean, you talk to Sam Parr and Sean Puri on the My First Million podcast, and they say, where are the most rich, dumb people? Where are the most rich, dumb people? And it's in real estate every time. I'm not ashamed to admit that. I am one of those rich, dumb people. So you have a lot of what's called mispriced real estate, under market rent real estate. So we buy a self-storage facility where we know they have not done the work to find true market rent. They haven't done the work to raise the rents to true market value. So when we do that, we can optimize these self-storage facilities. And again, customers leave, new customers come, we offer new amenities, we add online payments, we answer the phone 24/7. We are marketers, we are operators, and that is what we're focused on. So this is basically the dream scenario of how leverage, look, we're using 55% bank loan, and we are doubling our money in 6 months. Now, are we ready to start talking about the bad stuff, Matt? You can't just be happy-go-lucky and positive here the whole time.
Are you sure? I mean, that's what the people want. That's what I'm looking for. I know one quick thing is just people asking with the cash out refi, two things. Like you already mentioned that the banks are willing to do it. One of the things that people also asked is, do your LPs stick in the deal? Usually after, along with that, do you do any kind of restructuring?
Yeah,
of the LPs
their ownership. The way that, and we'd have to go really deep in the weeds, and this is the stuff that's in my real estate masterclass, is how to structure these deals from a preferred return and a promote perspective. I'm a sponsor. I get paid as part of the upside. So when we return all that capital, we own that property. It's split, based on the promote. If you're charging a 20% promote, then me as the sponsor, I'm going to own 20% of that deal after I get your entire amount of money back. But basically, we continue to own the property. We continue to cash flow the property. You're just now paying me because we're in the money. This has been a home run deal.
Yeah, that's awesome. One last thing before we move on to the bad stuff. Scott was asking, I think it's in another side of it. We've been talking about bank loans. Is there, like, how would you structure this if you're talking about taking on more private money versus bank financing?
Yeah. So this is private money. This cash invested, this $2.7 million did not come from me. I am a real estate syndicator, meaning I go to wealthy people and I say, hey, who wants to put money in this deal? This is what I'm projecting. I'm projecting 4.76% cash on cash, or 7% if we got an interest only loan, which we do right now. Who wants to put money in this deal? Here's my plan. And they put the money in. They're owed what's called a preferred return, which is like an interest rate on their money. They're owed that before the sponsor, me, makes any money. This is what's called syndication. And this is what we go deep in the woods on, in the weeds on, in my real estate masterclass. And by the way, the point of this webinar, guys, is that my life has changed a lot. Last year, 250 people bought my real estate masterclass. I've spent the last 3 months updating it, and we've spent the last 12 months growing our firm from 6 people to 40 people. And I'm learning a lot about real estate, and I have it all in 70,000 words now, Matt, 7 or 10 videos, a ton of resources to talk about real estate private equity, talk way more about the different types of debt, the way to manage all these different levers, because as a capital allocator, there's so many different things that you can do. There's different loan values, there's different preferred returns, there's different interest rates, there's different amortization schedules, there's different risks, there's different operational advantages. We cover all that. Do we have a landing page, Matt, that I can mention? Some people keep asking where they can read more about that.
We do. I'll drop it into the chat.
All right, cool. Let's talk about some things that are not so good here. Let's talk about how this can go terribly wrong. And let's talk about what happened to a lot of people in 2008, 2009. Everybody thinks there's a misconception that the people who went broke in 2008 and 2009 couldn't make their payments. They could not make their payments. They were bringing in $1,000 a month and their expenses were $2,000 a month. They ran out of money and they lost the property. The bank foreclosed on it. 90%, over 90% of the bankruptcies in real estate during the financial crisis were because the terms on loans ran out. The bank said, hey, we're at the end of your term and this loan is underwater and we are not going to give you more money on it. So you can either give us the property or you can come up with the difference. And we're going to talk about that now. Let's say we buy this property at a 5.48 cap rate. And let's say we're not able to make any changes to it. Let's just say revenue stayed the same and expenses stayed the same. So we had 0 NOI growth and the new value is 6%. But that new value is based on this 5.5 cap rate. Let's say that the cap rate is now not 5.5, but higher. And what causes cap rates to go higher? What causes real estate to get less valuable? Interest rates is the main one. I mean, in our business, we live and die by the bankers. When the bankers love our product and they're giving us cheap money, asset values increase. If the bankers don't love us and also all of a sudden our interest rate instead of 3.5% is 6.5%, our expenses are way, way higher. So Matt, I'm just looking at you. I'm going to ask you a question. If you're no longer allowed to get interest only, they're going to make you pay principal and interest on a loan, and your interest rate is going to be 6.5%. If you buy at a 5.5 cap rate, if you buy this same property at $6 million, your cash on cash return is going to be 2.28%. Would you buy that property at that time if you had to pay 6.5% for your money and the banks were not offering interest-only loans? No. The answer is no. No way. Why?
Judging from what I learned in the past 37 minutes, I would say I would wait for a better deal.
Right. It's not worth that anymore. If interest rates are higher, boom, your cap rates are going out. Your cap rates are going way out. Let's say, I'm just going to change. If I change this, it'll mess up the folder, but let's just change it to 7% cap rate. We're back to a 7% cap rate market, which is the cap rate market that we were in a year and a half ago. I was buying storage at a 7 cap, guys. It was amazing. All the properties I bought a year and a half ago are worth 2-3 times as much right now. But look, our new value. We bought this thing for $6 million. Our value is down 22%. Even though we make the same money, this property makes the same amount of money. The net operating income's the same. Holy cow. Let's say that we were more risky. Well, we're still underwater here. Look, we protected ourselves. This is a good example. We protected ourselves. Our new equity value is $1.4 million. Our equity's down 50%, but we're not going to have to sell. We're not going to have to sell at the bottom right now because the bank could come back to us and say, hey guys, your new value is 4.7 million. You got to refinance this thing. We'll give you the same terms. Let's get the deal done. Okay, boom. We're going to take a huge hit on our equity. We're not going to be able to cash out refi. We're going to be okay though. We're still going to have 1.4 million of equity in this deal. If we had to sell it and all of a sudden we could get 4.7 million, we could sell it. We're okay. Let's go back. Let's say Nick was a little bit greedier. Nick was a little bit less risk averse. Nick wanted to do more leverage, 70% loan to cost. This is pretty average. That's not even high. Let's say 80%. Let's say 80% just to be pretty high. Let's say I borrowed 80%. And this is where, if you're watching this and you have some loans out right now, you're going to start to get scared as you see how these things, come together here. Now our new equity value is underwater, Matt. And this is how people went broke. This is how people went broke. They bought at a 5.5 cap. The market went out. Nobody wanted to buy real estate. The real estate became less desirable. The bankers weren't lending as often or as liberally as they were now. And boom, the cap rate goes out. And now our $1.2 million that we put in this deal has become negative $100,000. And we're underwater. And if our term is up at this given moment, we talk about protecting, controlling for things that we can't, see. And when you need to refinance, how the bank feels about your loan, how the bank feels about your property, how the market would value your property and your interest rate, I can't control any of that stuff. So I'm not going to take that risk. I'm going to lever this thing down to 55% and protect my downside. I'm going to put more cash in. It hurts to put more cash in. It hurts to raise cash. It hurts your cash on cash return. It hurts everything, but we're going to be okay. We're still cash flowing, number one, and we still have $1.4 million of equity in this deal. Now let's go to another scenario. So that's the big one. Number one, guys, your term is up, the market's different, and it's worth less money. You're screwed. That could very, very well happen in the next bit. Now let's say expenses annually, they rise 5%. That's basically every single year. Let's say a pandemic happens and nobody can pay their rent. I own a multifamily storage facility or a multifamily facility that I paid $6 million for. And let's say I got 70% leverage on it. Let's say the interest rate's down. That's what I need to change here. Interest rate, I got interest at 3% on my multifamily development. It's cash on cash is 5%, 11% cash on cash if I got principal and interest. Things are going great. Let's say the pandemic happens and 20% of my tenants stop paying rent. 20% of my tenants stopped paying rent. So my revenue drops by 20%. What happened to my net operating income? It's amplified. The downside is actually amplified as well by the leverage. Who would have thought that while the leverage is a beautiful thing for increasing your value, and when things go well, you look like a genius and you make all kinds of money, who would have thought that, boom, my net 20% dip in revenue means 33% loss to my net operating income. My expense ratio goes up. My cash flow goes way down. It's actually in the negative if I'm amortizing. And bam, the value of my property is actually down 48%. That's pretty brutal. And that's how people also can lose big money quick in real estate. The ways to protect against this, say we went 50% leverage. Oh, look, we're still actually cash flowing. We're still actually cash flowing here with this figure. I'm going to go back and I'm going to change this because I actually just remembered this is equal to this divided by this. Boom. Let's go back to, oh, that's not right, is it? Yeah, no, it's net operating income, not revenue. 5.48 cap rate. I actually have this scenario too, the cap rate external factors outside of my control change. Purchase cap rate, 5.48%. Exit cap rate, let's just say it's 6. Let's say it's went out 50 basis points is all. Boom, my equity The value of my property in the old market is $4 million. Value now is 3.6. Equity at purchase was $1 million. Equity now 657. My equity has dropped 80% in value, 78% in value. And that is scary as well.
Now, I think
the point is,
I'm glad that you said, here are some things that we can do to guard against, this kind of like fallout. Could you talk a little bit more about that?
Yeah, I mean, this sheet is something that you can use. Take this sheet and punch in your deal, punch in your revenue, punch in your expenses, punch in how much you paid, punch in your cap rate, punch in your leverage, and then start playing with these two figures right here, revenue growth and expense growth. Let's say revenue and expenses stay the same. And this is the powerful thing, is all you need to do is keep revenue growing at the same time, at the same rate as your expenses. And if you do, your property will become more valuable over time. See, this is 5% increase per year. But if you're not, if your expenses and your revenue, these are the things that you've got to really protect against from the downside, because sometimes your revenue can drop and your revenue can drop 10%. What would happen to my deal? Am I still cash flowing? Yep, I'm still cash flowing, barely, but I'm still cash flowing. Okay, what if I went to 60% leverage on this thing? Now my revenue drops by 10%. What happens? And these are the questions that if you're going to invest with a sponsor, if you're watching this and you're like, okay, I'm a real estate investor, I'm putting my money with people, you can ask these questions to a sponsor. You can ask the sponsor, hey, can I see your model? Or, hey, what happens if your revenue actually drops instead of increases? Hey, what happens if your interest rates goes from 3.5% interest only to 5.5% and it's amortizing? What would that do to your business model? These are the assumptions that you're seeing sponsors make. When I'm underwriting a deal and figuring out what I'm going to buy or what I'm going to pass on and how much I'm going to pay, how much debt I'm going to use, how much capital I'm going to raise, what kind of debt I'm going to go after, these are the things that I am making assumptions on. I don't know. They're not fact. They're not fact. They're in a spreadsheet. They're not facts until I actually do it. I'm making a lot of assumptions. So you, as an investor, you have to be able to look at a sponsor's assumptions. And these are all the tools you need to look at these assumptions and figure out just how risky a deal is, so that you yourself in your head, you can say, okay, those returns look great, but that risk is not something I'm willing to take. Or, okay, this is low leverage. The downside is protected. Maybe the upside is, limited, because as you use more cash and less debt, the upside looks worse and worse because you have more equity in the deal. But if that upside is protected, if the downside is protected, that could be worth it for you in your situation. Now, another note is that the amount of risk I'm willing to take now that I have $25 million of investor capital from 250 people, and I have my entire net worth tied to my storage facility. We have multiple millions coming in every year of cash flow off the assets that we bought. My appetite for risk is totally different than yours. We built our first self-storage facility from the ground up with 75% leverage at a 5.5% amortizing loan. If I would have looked at this document and ran the figures on this document, it probably would have talked me out of doing that very first deal. But I was 25. I picked a good market. We were good operators. We had some things going for us. We got bailed out by a good market. And now I look like a genius, because that $2.9 million building we built back in 2017 is worth about $9 million now. And we're about to do another cash out refinance and put $2 more million of tax-free money in our banks. So when real estate goes well, you look like a genius, and everybody looks like a genius over the last 10 years. But the point of this little stress test in Excel right here is for you to be able to punch in some different figures. How is revenue growing? How are expenses growing? And what is going to happen to the value of my property after I've owned it for a while? And what would happen if? What would happen if? That's the most important, Matt. That's the most important thing. What would happen if this? What would happen if that? What would happen if I can't sell this property? And you got to look at the levers outside of your control as a real estate investor. I think of higher risk developers, people who are building a building from the ground up. There is no cash flow, right? There is no cash flow, and they're generally trying to sell it when it's done. That's their goal. So they need to get compensated really, really well for that risk, because you're making a bet on the market 3 years from now. You're not even making a bet on the market a year from now when you need to refinance. When you're building a project, when you're building a big development, you're making a bet on cap rates and interest rates and appetite and what somebody else thinks your property is worth 3 years from now. So if at that moment, when it's done, you have to sell that thing, you might get burned. So I like to say, okay, what's outside of my control? How can I limit these factors outside of my control and their influence and their impact on me and my business? And the answer almost always is, hey, if I don't need to sell at a specific time, that's good. If I don't need to refinance at a specific time, that's good. If revenue drops because of a pandemic, I'm going to be just fine. If somebody thinks my property is worth a lot less than what I bought it for a while, I'll be fine. If interest rates go from 3% to 7%, I'll be fine. And this is the document right here. This stress test is what you can run your deals through to see just how much margin for error you have and just how much risk you're taking. Give me some feedback in the chat, guys.
Was 485.
Beautiful.
Yeah, and we've got a lot of good questions. I think what would be a good use right now, I can pick out a couple, but if you want to look at the Q&A, because you'll have a better idea of what to pick out and say like, oh yeah, this is right on.
Yeah. So people keep asking, like, given what I have in these deals, they want to know a lot about my business. Like, what's my hurdle? How much cash do I have in the deals? All these things. Chris Power is a mentor of mine who I've done several podcasts with. If you go to the Nick Huber Show, the Nick Huber Show podcast is a kind of a dialogue between Chris and I in a lot of instances. It's not as simple as, okay, the upside is what's going to pay Nick. Because if we go through a tough market and I got to go 5 years without selling a deal or refinancing a deal, I still have to feed my people. I still have to be able to pay the bills. I still have to make monthly income as a real estate investor. So what you have is two models. I have a management company that manages the properties for a fee. That management company needs to be self-sustaining and profitable in its own right. So Chris Powers helped me raise those fees to a level where, okay, you have a healthy business. Even if all shit hits the fan and you can't refinance, you can't do deals, you can't take acquisition fees, you can't sell anything, you're going to have money coming in every month to pay your people. That's number one. Same with the real estate private equity company. We have AUM fees so that every month that real estate private equity company is profitable in its own right, no matter how well these deals do. And then our job is just to set these things up so that those levers outside of our control are, minimized. You can never de-risk real estate altogether unless you use all cash, no debt. And even then things can happen. But, we try to reduce again, I don't need to hit home runs now at this point in my career to keep this flywheel going. We just need to protect the downside and not lose any of these assets. And those are the kind of investors that we're attracting now. People are asking, how much money do I put into each deal? I wish I could put more, but people talk a lot about how real estate investors are asset rich and cash poor, meaning we don't have very much cash on hand at any given time. The good real estate investors, that's not the case. The good real estate investors do have cash on hand because the number one rule of real estate is to not run out of cash. If you run out of money, you're done. So it's expensive to keep cash on the sidelines, but we do it. We keep $2 to $3 million liquid at all times. Very painful to see that getting eaten away by inflation, but it is our margin of safety. It is what's going to keep us out of a pickle, and it is what's going to allow us to pounce on new opportunities as we get them. Anything else you notice?
There's one I think that stood out, asking your outlook on short-term and long-term appetite for new deals, especially given the Fed position on interest rate. Would you look at development again, or just wait for values to normalize in your current?
Yeah, I am scared. Portfolio? I am scared shitless of development. I'm scared shitless of it. I think the developers are not getting an adequate risk-adjusted return. And obviously, there's a ton of nuance to this. There's a ton of really good developers. People are selling deals almost before they're done developing them, or getting a contract in place to sell them when they're done. There's things you can do as a developer to reduce risk as well. But I mean, yeah, I don't know where we'll be 3 years from now. I don't know where interest rates will be. I know that if interest rates go up to 8 or 9%, I'm going to be able to survive and I won't lose any of my properties. I'm very proud of that. But I also know that 10 years from now, we're going to be in a really good spot because we're going to out-operate everybody. We're going to lease these properties really well. We're going to drive revenue really well, and we're going to do our part. So I don't really care what happens 12 months from now. I'll buy more storage. I don't care what happens 2 years from now. I'll buy more storage. I care about what happens. I care about where I'll be 10 years from now. And that's kind of what I'm focused on as a real estate investor. And people keep asking about the course. I'm going to give a direct promotion now.
So for the next day, you can get 30% off the masterclass.
Yep. So it's nickhuber.podia.com/real estate. And the coupon is fast action, all one word, all uppercase. I'm going to put this on sale for about 3 or 4 days here, and then we're going to cut it off again. But I'm really proud of it. It's got everything I know about real estate operations, financing, and managing a lot of these risk factors that we've been discussing today.
Yeah, everyone, I've been through it. I've looked through it, and everything that Nick talked about in this is just so much more detail. Like, I know we've mentioned that a couple of times, but it if you just go through and you look even at just the info page of seeing all the different factors, all the different aspects of this that you can dive into to evaluate deals. There are some of these in terms of revenue, interest rate, costs, like all these things, like how to grow, how to increase your revenue, things that you can do, basically all the questions. And we got over 60 questions in the Q&A. There's some version of this that is very likely going to be answered in the course.
Yep. And how to capitalize deals. We didn't touch on that at all. Meaning, okay, if we're buying a $6 million property, you have to set aside operations capital. You got to set aside capital reserves to fix your property if you're having problems with it. All these intricacies that make real estate very unapproachable. And the big problem with real estate is that if you don't speak the language, you're at a pretty significant disadvantage. I mean, most of the people in the world who own real estate, they come from real estate families, and they have an unfair advantage when you come from a real estate family because you grew up around the lingo. I didn't have that, privilege, so I had to learn it myself. And now I basically just created this, with myself and something I wish I had when I was 25 years old, about to, cut loose on that very first self-storage facility.
A couple of questions about the masterclass itself. What's the difference between the masterclass and then something that's more consulting with you?
I do consulting for people who have a live self-storage deal that they want help underwriting, meaning because there's so much nuance in real estate. What a property is worth to me is much different than what a property is worth to you, Matt, or what a property is worth to somebody else. So that is a customized one-on-one session where I give you my underwriting tools and we go through the process of figuring out what to offer on a facility. The masterclass is basically a resource where you can learn real estate private equity. You can learn how to spot opportunities. If you're early in your career and you don't know which way to go, it can give you a 3,000 square foot view, a 3,000 foot view of, okay, here's the different asset classes. Here's how to think about opportunity. Here's how to think about risk. Here's how to think about operations. What might I want to go to? Then on the other side of it, it's, okay, I own a couple properties. I have some cash and I want to build a flywheel like Nick and raise money and buy more real estate and build a sustainable, healthy company. That is really exactly who it's for. And then there are people like LPs who maybe they don't have the time to buy a piece of property themselves, but they want to understand enough about real estate that they can spot good deals. They can ask the right questions. They can invest with the right sponsors. It's perfect for them as well. And we're also going to do a scholarship, I think, Matt, right? If you are a student or you're very early in the journey and you cannot afford the price of the masterclass, send us an email, nick@sweatystartup.com. And we're going to give a couple folks scholarships, discounted course if they're pretty early on in the journey.
That's excellent. One last question. I think you've covered it just to be more direct, but how specific is this to storage across other asset classes?
I mean, storage is my business. So the masterclass definitely has a skew towards storage. When I do the deal breakdowns, I'm talking about how I operate self-storage facilities as a small business. But all of these concepts, every single one of them could be applied to strip malls or mobile homes or hotels or multifamily. So I'd say that you're going to get some bonus value if you're in the self-storage business, but very much oriented towards everybody who is in real estate. This has been awesome. 350 people. I'm proud of us, Matt.
Yeah, great turnout. Lots
Thanks,
more to
guys.
get the replay.
This has been awesome. We're going to get the replay out for everybody. Have a great evening. Have a good week, and check out the masterclass. I'm excited about it, and hopefully we have a good go getting it out there.